Martha Leonard comes to us from Davis and Hodgdon, John Davis has usually done this type of pitch, but we're going down into details now. So he sent us his person who is very good at helping people with their bookkeeping needs. She's taught not only a lot of their clients, but she's also taught this type of session at the Women's Small Business Program as part of Mercy Connections. So at this time, I'd just like to turn it over to Martha.
So as Louise said, I work with Davis and Hodgdon, and I've been there for about 2 years. I lead up our remote accounting department. It's a new offshoot. Its acronym is RAD, R-A-D. So we're the RAD department. And the we is me. I'm trying to build it. We do have a good number of clients coming on board, so I just told Brett Hodgdon today, I said, I think I'm going to be waving the white flag pretty soon because I'm going to be out of time. Like Louise said, I've taught some of this material at the Mercy Connections with the Women's Small Business. We used a book there, and I didn't put that in with the presentation. And this book is pretty elementary for basic record keeping and accounting for successful small businesses. And it doesn't really do much in regards to the electronic bookkeeping. It's more doing everything manual. So I would say that once you learn the terminology and the basics of how this system works, you probably don't want to be doing ledgers like we did way back in the day. So my kids would have no idea what those even were all about. So what we want to do at the end of the session is actually show you where all of these reports are coming from, because you need to get the information into the system in a way. Does anybody not have a packet that has all of the slides? Okay. So the very first financial statement I really want to talk about is the balance sheet. And so the very first paper in front of you is the balance sheet. So a balance sheet, and this one is going to be geared around service type of industry, which I was happy to see a lot of you are in. There are also financial reports for the product side, but they look very similar. So don't feel like you're missing out because we're doing something with the service industry. Okay. So the balance sheet is really designed to give you an idea of what your business, what it's worth on a given day. So if you look at the top of this balance sheet, there's a date on it. So the date's very important because you could run a balance sheet for any day. And so it's really depending on that day. This is exactly what you have for assets, you have for liabilities, and you have for equity. Okay? So, and the reason that we're doing these financial statements is there's a couple reasons. One is so that you have an idea of how your business is doing, but also so you can show maybe a banker, if you're trying to get some money, how your business is doing. And of course, you have to do your taxes as well. So we hope you all come to Davis and Hodgdon right across the street. So we want to make sure these are in good order when you bring them to us. If they're not, they're going to send you my way so I can help get the books in a good spot. Excuse me, a good spot. Okay. So the balance sheet is made up of 3 different sections. The top section is the assets. You have the current assets, which would be any kind of a bank account that you have, any kind of cash you have on hand, that type of thing. And there's 2 different columns here. So the column on the left is as of this year, and then the second column over is for the month before. So the month before can be compared. You could also compare the year before, so you can see side by side how much you have this year compared to how much you had the previous year. So you can compare where you're at. Okay, so below the current assets we have accounts receivable. So when you have provided some type of a service, but your customer hasn't paid yet, you're going to have a receivable on your book that's worth something. So it's money that you are expecting to receive, you hope to receive, And so that's what that's all about. Okay. Other types of assets that you might find are fixed assets. So fixed assets are those that you are going to have for a longer period of time. So the fixed assets would be, in this case, we have a truck. You could have equipment. You could have some land or property. So something that's going to last for a while is going to be a fixed asset. Now, when you have a fixed asset, you also depreciate that asset. So think about it this way. If you go and you buy for your business a new not a calculator, they don't use those anymore. If you go and you buy something small for your business, so say you're buying a new, I can't even think.
Like laptop?
Well, a laptop, right, very good. You probably are going to take that expense all at once on your business, as compared to if you were to go and buy a whole nice big desk that's worth a couple $1,000s. It's really nice wood. So what will happen with that type of an asset when you go to buy it is that you'll add it to your fixed assets here on your balance sheet. And then you'll also, over the life of that particular asset, you'll be able to depreciate that asset over time. So each year, the asset will be worth a little bit less, and you'll get the expense that you'll be able to use against income you're earning. We're going to talk about income and expenses on a different statement here. So I just want to explain what that accumulated depreciation is all about on that line in the balance sheet. Okay? Question?
So does that, just for this purpose of this example, that $200 of depreciation is for that particular truck?
Right. Well, and it could be if there were more than one asset, that would all be a lump together. So I made this really simple in this situation, so it is just for that truck. But if you had multiple assets.
You're not going to put depreciation for something that you're not listing there.
Correct.
And is the value of the truck what you bought it for? And then the accumulated depreciation is how much is depreciated since you purchased it?
Right. So on this example in front of you, the amount that's showing there, the $13,495, that's what it's worth on August 31st. And if you look at July 31st, there's nothing in that column.
Right.
So that means we bought that somewhere between that.
So more than likely that amount is the purchase price. So then the purchase price versus against the depreciation, that's what you're putting there.
Right, right. Okay, does that make sense to everybody? Okay. Okay, so as time goes on, that truck is going to be worth less and less as it gets older, which we know that's the way it works. Other than for insurance purposes, they still keep putting the rates up. I think that's not very fair. Okay. So any other questions about assets? Any other types of assets that you all might have that you have a question about how you would?
How do you know how to depreciate? How much?
Well, that is a good question because that's what your tax preparer is all about. So you would want to talk to your tax advisor. A lot of times what will happen when you purchase an asset like this truck, you'll put the total value in when you buy it, and then when you go to the accountant at the end of the year, then they'll say, okay, you should be taking this much each month, and they'll set it up, or they'll have me set it up so that it will come on your books automatically each month. Okay. Is that good? Okay, any other questions? Okay, so the other thing with the balance sheet is that the reason it's called a balance sheet is because the total assets, that total on that first column of $18,236.91, is going to equal the liabilities plus the equity. So on the very bottom of that column, you'll see that same number. Okay? So what you have for assets, you had to either take out a loan, or you had to put your own money in to buy it, or you may have been receiving some income and then you went and purchased something. But that's why these two sections are going to equal each other. So you take the assets, then you look at the liabilities. So let's talk about the liabilities next. Okay, so for liabilities, some of the examples I show on here are current liabilities versus long-term liabilities. So current is the same as with the assets. So something that's not going to be around for a while is going to be a current liability. So a credit card payment that maybe you just haven't, the cycle is such that you haven't paid it yet, that would show up here. You have accounts payable. So just like the receivable side, you also have things that you might have purchased from other vendors and you haven't paid for them yet. So you have bought something on account. So the accounts payable is what you owe to other people, rather than the accounts receivable is what other people owe you. Okay, sometimes those two get a little confused. So the current liabilities and then the long-term liabilities. So when we bought the truck, there's another example. We took out a loan. So the value of the truck is not always going to be the same as the value of the loan, because as you go along, you're paying this loan off. The loan hopefully will be zero really quick, but the value of your truck's going to hopefully stay pretty high for a while. Okay, so the truck loan is what's the principal balance that's owed. And so when you make payments on that truck, unless you're fortunate enough to get a 0% interest rate, you're going to have some interest payment as part of those monthly payments. And again, the same question might come up. How do I know what's interest? How do I know what's principal? And you can get that from your bank that you've taken your loan from. Sometimes people will make that distinction as you're paying this payment off. Sometimes you'll wait till the end of the year and just see what your value of your loan is left, and then the difference between what you bought it, what you took the loan for and how much you still owe at the end of the year, you can make an entry to write that down so that you use the interest as an expense that you can use for your business. And we're going to talk about that again on the profit and loss statement, how those expenses come into play. Question about loans at all, or any other types of liabilities that you might incur? Okay, all right. So then we have equity. So a lot of times in the accounting world, we like to use the equation of assets minus liabilities equals the equity, because the equity is usually the more difficult number to get to. You know what you have for assets, and you know what you have for liabilities. So what's left over is what's equity. So equity is what your money that you've put into the business, or profits that you have accumulated over time since you've been running this business. So if you look in that section on here, we have an opening balance equity number of 5,000. So when we started this Craig's Design and Landscaping service, probably what happened is the owner made a $5,000 deposit into a bank account. That's typically how it ends up being. You got to start with something, so it's got to come out of a pocket to go into another place. So the $5,000 is offsetting the $5,000 in the checking account that you put it into. So if I had run a balance sheet on the very first day of when we started this business, the very top section would say checking 5,000. The bottom section would say opening balance equity 5,000. Top number for assets equals the liabilities and equity. We don't owe anything yet because we haven't done anything yet. Right? So does that make sense? It's this whole double, you have to have things balanced in your accounting world.
The 184.49, is that a number that's meant to be the same every month, or does it show up twice?
Nope. I wanted to specifically show you this one because when we get to the third page, you can peek at it really quickly, but don't stay on that page. At the very end of that page, the profit and the loss for the year to date from January through August of 2017 is 184.49. Okay, so that number is what's in the balance sheet on that day. So as...
It looks like it's in the balance sheet twice. Well, at least you said the owner probably put $5,000 in, and now it's 5,184.
Right. So they've made a profit for this year, and so the profit is also part of your equity, because you don't want... when you start your business and you put that 5,000 in, you hope you're going to grow your business. So this equity should always be getting bigger and bigger. If it's going.
I don't understand why it's there twice. One says standalone and one's with the 5,000.
Right. Because what ends up happening is when you actually bring in income or spend expenses, your checking account's going up and down, right? You're putting deposits in and you're spending money out. So it's hitting the top part of this balance sheet, and so it has to be offset in some way or another. So it's an equity that you're adding to your company. Okay, if you still are unclear about it, I certainly can talk to you more about it at the end. Does anybody else have a question about that? I don't want to make it sound.
Looking at the total equity, it's the 5,000 open balance equity plus the net income of
Oh, I see.
149. So
Right.
that's your total equity.
Yeah. So the 5,184 isn't one of the numbers that adds to the 18
Correct.
numbers.
Okay.
Correct.
It's a
It's the
subtotal.
total, yep.
All
Okay,
right,
got it.
sorry. Yeah, sometimes the translation, I can't quite get the question. I appreciate that, thank you. All right, so the total liabilities was $13,052.42, and the total equity is $5,184.49. So if you add those two numbers together, that's your total liabilities and equity. Yeah, these balance sheets, all these financial statements, you can make them as long or as short as you want. And I purposely expanded some sections so that you could see the detail, and I shrunk other sections so we didn't have quite as many different things to get through, knowing that I didn't have infinite amount of time. And so that's why that's showing the detail. I could have shrunk it down and just said this is the total equity and that was it.
What's the difference between current liabilities and long-term?
Okay, so current is typically 1 year or less is what people tend to categorize by. All right, on to the next one we go. Okay, now you're going to find there's two different profit and loss statements. And that's because I wanted to do just 1 month, and then I wanted to show a year to date, so it's showing you the whole year. So a profit and loss statement is also called an income statement. So the profit and loss statement is different than the balance sheet in the fact that you're actually looking at how much you've earned or lost, hopefully earned, for a specific time frame. So you can look at a profit and loss statement for 1 month, which is what I have here, or the next page you can do a period of time, which is from January through August on that second one. Okay. Typically, again, you want to be able to compare time frames. So on this first one, again, I did the August of 2017, and then another column for the July of 2017. Now, in my world, I would normally want to see August 2017 and then August 2016, so I compare month to month. But I took something off a sample company, and I liked the numbers showing here different. So that's the only reason that I picked comparing it to a month rather than a year before. Okay, so what this is showing you is at the top section, all of the income you've earned for that time period. And then the bottom section shows all the expenses that you have paid out of that business. Then down at the bottom, you're going to end up with what's called net operating income, which is what you're earning with your business, the operating income. And then the number right below it is the same number as net income. Now, let me go back up to the top first, and then I'll explain going down, because there is a lot to each of these. And so I just want to make sure these are really clear. So the income at the top, this is a design and landscaping service. So what they're doing is showing the different types of income that they're getting from that business. So the top line, the landscaping services, is how much they earned with that particular section of their business. So the nice thing with setting up these online bookkeeping accounting software is that you can be very specific as to breaking down income and expenses in the way that's going to make the most sense to you as the business owner. You don't have to lump everything into one big category. That's a mistake a lot of people make, is that they say, well, here's all my income, and here's all my expenses. The expenses, they usually split out, but the income is like, okay, here it is, it's all in a bucket, boom. It's hard to judge like how much of your business is coming from your service compared to some of the other factors. Okay, so just keep that in mind when you're setting up your system. So there's other items up here at the top. So when this landscaping and design company does their work, they have materials that they purchase specifically for that job. And so the income at the top here that says 422 is the job materials that they bought that they billed to the customer. So this isn't an expense, it's what was on the invoice they sent to the client, and when they paid it, part of it was for the service, part of it was for the materials. So it was a little bit confusing when I printed this out. I thought, okay, they're going to see job materials at the top and they're going to see it at the bottom. So I wanted to make sure I was very specific as to what the difference between the two is. And I did not intend to confuse matters. It just after the fact I thought maybe I should have not used that particular example. So the bills that you send to your customers, if there's items that you've purchased specifically for that service, are going to be listed on the invoice, and when the customer pays the invoice, this is where that 422 comes from. Question?
So, when does the income occur? When you send out a bill or when they get a check?
Very good question. Okay. So there's two different ways that you can account for things, and I didn't write this in here anywhere, so I'm so glad you brought that up. So there's two different methods in the accounting world. You have an accrual basis and you have a cost basis. So a lot of businesses will just start out with cost basis, which means that when you physically get the money in your hand, that's when it's showing up as income.
You mean cash basis?
Cash.
Cash basis.
Did I say?
You said
Oh,
cost basis.
thank you for catching me. Don't want to confuse the matter. So with a cash basis, when you get the cash in your hand, that's when it shows up on the income side. When you pay the expense out, when the money's physically coming out of your pocket, that's when it shows up in the expense side. Whereas with the accrual is trying to match the income when you've performed the service and the expense when you've incurred the expense, so that it's showing up in the same period of time. So it makes more sense when you're comparing, especially if you're looking month to month and you're trying to say, when is my business doing the best? You can compare that more easily with the accrual basis. And you can switch after you've begun. It's just probably easiest to start with the cash basis to begin with.
I was under the impression that the IRS made whether or not you were cash basis or accrual basis.
You know, that would be a good question for your tax preparer, because I am not a tax preparer. So yeah, there may be situations where they determine that you have to use one or the other. Thank you for adding that. Yeah, anytime you're starting up a business, you know, your accountant's like one of your best buddies. And I'm not just saying that because I work for Davis and Hodgdon. It's the truth, because you really want to start off on a good foot. They'll really help you with that.
So, so the accrual basis is not when the exact moment when the when the funds are changing hands. It's like when you build somebody, that's
Absolutely.
when that amount appears. That's when it appears. And when you've been billed, or is it when you've paid for the bill?
So say like with a credit card, if you were doing a cash basis, you probably wouldn't show that expense if you went and bought something today until you actually paid for it the day that you paid for it on your credit card. Same with the income, like you said. With the accrual basis, as soon as you send the bill, that's considered the date that you've actually performed that service. And you try to bill at in the same time period. So like for our business, at the end of the month, we make sure that all of our bills for our customers go out in the month that we perform the service.
How about when you take a deposit? I'm taking a $500 deposit, $500 for next September.
Right, right. So again, it's if you're on a cash basis, that $500, you got it now. So it's
It is a liability, because what if they could cancel and I have to give it back?
So that's where you go back to that balance sheet. So when you bring the money in, it's not going to just land in one place. It's going to be on both sides of that balance sheet. So the cash will come in on your account, you're putting it into your assets, but it's also going to show up as a payable because you still owe somebody something for that. Okay? Good questions.
Just a quick question with these expenses with credit cards. So if I go over to Walmart and I charge something right now, is it okay to put it into my accounting software as a charge I incurred today, or do I have to wait till it shows up on my bill when I pay it?
If you came to me, I would prefer you write it down the minute you do it because
Good.
I,
That's what I'm doing.
that's what I encourage all of our bookkeeping clients is to put it in. And we are going to try to get to see QuickBooks Online as a demonstration just a little bit at the end of the session, depending on how far we get. But your credit card account can be set up exactly like your checking account, where you start out with a zero balance. When you purchase something, you put it into the register as, okay, I just bought something, so you owe how much. And then when you make the payment, you don't always pay the full payment.
Right.
And that's where people get into a problem, is if you're not paying the full amount, when do you actually enter it into your accounting system? If you enter it like a register, you just put the payment, and now you can still see your remaining balance out there. But the expenses are going in as you're going. You can wait until you get the credit card statement and back it out. I don't prefer that because that's just saying, okay, the credit card company's right. We all know that credit card companies, banking, they all make mistakes. So if you're just working off a statement for your bank account, that my kids don't even know how to reconcile. And I do this for a living, kids. This is not a good plan just to look online and see what your balance is. That might not be the, hopefully they're off in a good way, not a bad way.
But but the charge on the credit card is the expense, not the payment to the credit card. Because
Correct.
otherwise that's,
Correct.
yeah.
Because what ends up happening,
Payment to the credit card is just funding the expense, but the actual expense is just the charge itself.
Right. So if you look at the bottom of this profit and loss comparison, this will actually show you. So say you went to the garden supply, and you bought plants and soil. So down under the job materials, and we haven't gotten down here yet, but just because the question's out there, when you bought something there, the charge goes into that credit card account. It'll actually populate on the expense portion of this statement. So it'll show that amount in the date that it happened. And then what ends up happening is, okay, so that's going there, and then on the balance sheet, your credit card payable just went up a little bit. So it's showing up in two different places. Okay? And it is a little overwhelming if you haven't worked with financial statements to understand how these two flow together. But you really have to think of it as the very end of this is the net income. And the net income is where it's going to flow into the balance sheet. Okay. Any other questions about the credit card? Credit card's a big thing. I know I've had to train a lot of people on how to get that in the system in the way that really works the most efficiently. If you do pay off your credit card bill every month, which is always a good plan, you could enter the whole statement when you make the payment. You would just put the payment in, and then you can split out what it goes to for each one. The problem comes when you don't pay the whole thing off, because that's where people put in the wrong thing. They'll just say, well, okay, I don't know what this amount was for, so they'll just throw it into one category. And that's when they called me and say, Martha, I need you to go visit. So we've done this a few times. Okay, so coming back to this profit and loss comparison. So the top section is income, different income that you have received. The labor, again, is, you think of it as an expense, but again, when you bill your client for the service, you're billing them for labor. So when you get the money in, the money is attributed to labor. So you can see that what part of your income is coming from the services, from the materials, from the labor. It all gets broken out here. And then there's another service here, the pest control services. So you can kind of compare how much you're getting on a monthly basis for the different types of services. And then you come down to the total income. So the total income is $942 for that month of August. And then we have a gross profit, and I didn't put in a category that's called cost of goods sold, and I did that intentionally because sometimes people get confused over that. I will say that if you do have questions about that, I'm happy to answer. But cost of goods sold would be what types of things that you have to pay to run your business. And if you didn't, you wouldn't be able to run your business. And so I wanted to keep it as simple as possible just because there's so much we're trying to cover in one night. But if you do have questions about that, maybe we can save them for the Q&A at the end. Is that okay with everybody? So typically what you'll see is the total income. If you want to write a little line in the middle of it, right below income would be your cost of goods sold. So if we did have a cost of goods sold category in here, that's where it would show up. And then it would be your income minus your cost of goods sold would get you to your gross profit. Okay? All right, so then we're on to expenses. So all kinds of expenses. We have automobile expenses, we have depreciation expense. So here's where that $200 is coming in from that monthly depreciation on the truck. You're not paying $200 a month, but you get the benefit of not having to pay as much tax on all this income because you're writing off part of that asset over time. So, bless you, as you get more and more assets into your business, that number should get higher and higher. It's a very nice benefit to have. Different job expenses. Now, these would be expenses that you have incurred, but you haven't been paid for yet. So there's money that you've spent on different types of items that you need for your business, but you haven't been paid for them yet. And this was only for that month or whatever the time frame is. Okay, legal and professional, we always have that. Supplies, any kind of supplies you use for your business, and utilities. So some common types of expenses you'll have for your business. So you come down to total expenses. So you take your gross profit minus your total expenses to get to your net operating income. Okay, now I'm going to get the question, why is there two lines here? So the net operating income is not always going to be the same as the net income. The net income is going to be after you take out any kind of other expenses or add any other types of income. So example, and again, this would kind of be between these two lines. This didn't have an example of that for this company. Say that you had to pay some kind of bank fees. Your bank fees aren't something that you would normally have to deal with your business. Maybe you had like, hopefully not overdraft, some wire transfer fees or some kinds of things like that. You might put that into another type of an expense. Or if you had some kind of interest that you were earning on an account, you have some kind of investment out there that you're earning interest on, that would be something that would be, again, outside of your regular operating functions, that you can make that distinction, right? To me, my net income is really the number I'm looking for when I'm working with people's books. That's more what I'm looking for, and a lot of times for tax purposes, that's the final number, but there are distinctions between those two. Questions about that at all?
So I use a booking engine and they have a small fee that they charge me.
Mm-hmm.
So I could do it either by showing the amount that I collect or the total amount that I charge less that.
Mm-hmm.
I could do it either way.
Right. Yeah, anytime you have a fee for any kind of, I have a client that does tickets for like music events, and they have to pay a ticketing fee. It depends on what you really want to show. Is do you want to see the total income and then you see how much fee you're paying throughout the year, or do you just kind of lump it together? Because in the end, when you do your taxes, I do know at least this little bit, you have your income and then it's subtracting that expense out. So it's not going to make your business earn any more or less by splitting it out.
No, but
really
it's
just
interesting to know what I'm paying.
Mm-hmm.
And that would be the interesting
And
part.
I would recommend that.
Right.
I would definitely recommend that. Okay.
Pain in the neck.
Yeah. Other questions? Yeah.
Would that be considered cost of goods sold or be considered something else in expectation?
Well, what kind of business is it that you're?
So I run tours, and I have an online booking engine, so people will go right online, book their tour, and then there's a fee charged for clearing the credit card.
Typically, the cost of goods sold is going to be equated to something that if you sell more or you produce more, that fee is going to get higher depending on how much.
Like square up, right? Like the whole square swipe thing.
I would say that's an expense.
It's an
compared
expense,
to
it's
cost
not.
of goods sold.
Even though the more you sell, obviously, the more money they're gonna take, because it's the same
I
percentage.
mean, in the end, for tax purposes, it really doesn't make a difference. It's really how you want to see what these statements look like for yourself. There's not really a right or wrong on a lot of these things. It's really just a matter of where you want it to land on those statements so that you can assess what your business is doing. Okay, that makes sense? Okay. All right, great question. Any other questions? Okay, so let's hop on to the next profit and loss. We're only going to spend a couple seconds on this one because I want to get to some other things. Okay. So the profit and loss for January through August. Okay, so for this one, I wanted to show that you don't always have to have a comparison of one period of time to another. So it just has the one. And then I also just wanted to emphasize that you can break things out in a way that makes the most sense to you. So at the very top you have landscaping services, and right below it you have job materials. Now job materials is made up of 3 different types of job materials. So if you wanted to just say, okay, I'm just going to throw everything into job materials, you wouldn't have to set up all 3 of these. These are called sub-accounts for that account. But if you want to be able to see how much is coming in from each of those, then you want to be able to set those up as separate accounts. Okay, so it's how much you want to see in detail, or maybe it's not that important to you. If you ask John Davis, I can speak for him hopefully, because we've spoken about this with a lot of our clients before. The more detail you have, the better, because it really just gives you even more to assess about how your business is doing. So in the end, if you just say, I guess I've got a few too many, we can combine them. It's not that difficult. But to begin with, break it out so that it makes the most sense to you. Okay, so again, that's what I wanted to really emphasize here. There's a few more categories because there was more time. There were more types of expenses down here. So there was, well, I guess I broke it down before here. Yeah, down where we have the legal and professional fees. On the page before, that was just a total, and on this, I broke it out over the different types of fees, so you can see in more detail.
Not really a question, just a comment, but I'm sure it happens to other people too. We used to have a huge number of subcategories, just a very big chart of accounts, and we found the more accounts we had, the more things got misposted.
Okay, that's true too. That is true. There is times when you can have too many. And again, I would talk to your tax preparer. A lot of times it will match up to what you're using for a tax return and the categories that you're going to use for that return as well. So sometimes they'll give you suggestions as to which categories to set up for your expenses and your income. Okay. But yeah, that's probably a common thing that happens in my world, is that people post 1 year or 1 month to one expense account and then the next time to a different one. So when you're trying to compare the 2 different time frames, you're not really comparing apples to apples because they're in a different one each time. So consistency is what's important, and that's what we try to do when we take on these clients ourselves, is to give that consistency so you can really have a true analysis of how your business is doing in those different areas. Great. Great. All right, any other questions about profit and loss? No. Yep.
So, on the full year one, well, until the end of August,
Right.
it's 184.49 for net income, and
On your balance
you have on your balance sheet your net income as 184.49.
Correct.
But how come the 2 months that you're comparing, the 2 net incomes don't add to the 184.49 when your balance sheet over here is those same 2 months and your net income is 184.49?
Okay, good question. So if you go back to your balance sheet, go back here. Okay, what we're trying to compare is the total net income for, this thing is really picky. The 184.49 on that first column is equating to that profit and loss for that January to August. I don't have a comparison on that sheet that would show you the total, and that's the problem, is that what you're seeing on the balance sheet as 204.17 is an accumulation from January through July 31st rather than through August 31st.
Oh, never mind, yeah.
Okay, so that's why it's not showing up. Okay. Any other questions about the profit and loss? All right, so let's keep going. All right, so the next statement we're going to look at is statement of cash flows. Now, I think there's a couple blank ones here. Let's go on to the one that actually has the numbers. The only reason I gave you the other one is so that if you had your own business, you could kind of fill some of those in if you wanted to practice with it. And the tips page kind of gives you some advice on how to do that. Okay, so the statement of cash flows is one of those statements that I don't work with on a regular basis. It's really intended more when you're starting up your business to know how you're going to make this business function and be able to stay above water. So when you go to try to get money from a bank, this is a statement they look really closely at so that they can see if we're going to give you money, we want to make sure your business is going to, be able to do what you say it's going to do. And so I know these numbers are really little, so I apologize for that, but I needed to be able to cram it all onto one page. So the statement of cash flows is going to look very similar to an income statement. The categories will look very similar, but the difference is that the statement of cash flows is actual cash going in and coming out. It's not taking into account depreciation or other types of receivables or payables. It's what you're physically taking in and what you're paying out.
So where is the loan amortization payments?
Well, because the loan amortization, you're not.
I mean, that's cash going out when you're paying back a loan.
Right, but when you make the payment is the money that's going out, the actual amount of the.
Where is it on here? That's what I'm asking.
Oh, well, if you had any kind of interest.
No, I'm talking about paying off the capital of a loan. Like there's a truck loan, right? So every month you're paying, I don't know, $10, $20, $50 of the loan back.
Right.
So where does that show up on the cash
So
flow?
it would be probably like an automobile expense or something like that.
Operating expenses further down. Automobile transportation expense.
Right.
Yeah, but that's not a loan payment.
But if that's what the loan is for?
Well, I'm assuming that when it says automobile expense, it's like, oil changes and gasoline and stuff like that.
Right, probably something that's associated with that category, though.
Okay. But it would be in here. Is what
Oh,
you're
yeah,
saying.
you definitely would have to account for the fact that you're paying on a loan.
Okay.
Absolutely. Okay. So the top section here, you were starting out, so this cash flow statement's going from 7/1 of 2015 through September 30th of 2015. And so the beginning balance at the top, the beginning cash on hand, if we had already been running this business, you would be getting that number from that previous period. Otherwise, you're probably going to start with zero, starting with your new business. So then you're going to have to show where's the cash coming in. So the next is adding your cash receipts. So any type of income that you're going to be receiving in, you're going to see here. Okay, any interest income is also in here. So any type of receipt that you're going to get is showing in that top section. The next is showing the cash payments going out. So we have salaries, payroll taxes, supplies, anything that you're going to need to buy for your business to operate your business is in. So this is the category we didn't have on the income statement. They may have been on the expense section of the profit and loss instead. And then the operating expenses are down below here. So anything that you're paying out for your business during that time frame is listed here. And you come down to other expense payments. So the interest expense, sir, that would actually be part of that payment would be the interest. Would be in this category as well.
Saying the amortization is included in the interest?
So when you are, so you're talking about when you bought, you took a loan on your business when you started up, then over time you're trying to write that down.
Well, you're paying it off every month, right?
Well, you're not necessarily paying it off every month. It's kind of like the fixed asset where
Okay.
its
I see, if you have a
value
term loan,
is
you
going
could
down.
pay interest on it.
Right.
I have a loan where I'm paying it off every month, and I just wanted to understand how that
Okay.
shows up in the cash flow.
Right, right. Yep. So part of it would be principal would be part of an expense, and then the interest part would be in the bottom section here. Okay, then you have income tax that you're going to have to pay on that business. You also need to account for that. That wasn't on the profit and loss statement. So anything physically you're paying out or that you're bringing in is on this statement. And then you get down to the last section here, the cash position at the end of the month is taking what the beginning balance was, adding the receipts, taking out the expenses to get where you're at the end of the month. And again, it's just all about cash. Questions about that at all?
Why am I using this?
It's mainly to just see if from month to month or certain time frames, how are you going to get by in your business? Because
But aren't I seeing that from profit and loss?
not necessarily, because your profit and loss is it's not taking into account exactly the cash. It's also taking other factors into play. And a lot of times these cash flow statements are going to be, this one only shows 3 periods. It's going to be like for a whole year. You'll say like January, how's it going to look? So there's going to be months that, oops, we're not going to make enough that month, but the next month hopefully you're going to make up for it. So you'll see the cycles of how your business is going to do. And that also helps analyze that as well. So when is it going to be really good? And
So you're saying that this statement would get broken out potentially month to month throughout a whole year?
But it's showing a lot more detail, right?
right,
Essentially, that's,
well, you could.
well, no, I'm saying this, your statement of cash flows just shows a lot more detail. It shows where the money's going, right?
Right.
As
Well,
opposed to the other one.
right. So the income statement is, or the profit and loss statement is, right, showing you what exactly you've had for that particular time frame, whereas the cash flow is,
It's almost like an overview versus the details.
some of it will be the same. Some of those numbers will be the same.
But following your example, if you book an expense when you buy something and put it on your credit card, on the cash flow, you wouldn't show anything until you paid the credit card bill, right?
Correct.
So the cash flow statement is gonna show you, is gonna more closely correspond, it's gonna show you when you're gonna have enough money to make ends meet. Whereas the profit and loss, the income statement, may not show you that because your expenses aren't booked at the same instant that you write a check
Right.
necessarily,
Right.
right?
I don't know about other people's businesses either, but I look at this to compare the money that is coming in for me versus my payroll and how those change month to month and how, because I have sort of a seasonal business, so it definitely is good for me to look at these month to month so that I can see my payroll expenses and to reduce those if my, my cash that's coming in isn't as much so that I can make sure my payroll goes down. This is also really good for that.
I think it's probably important to know that it's looking forward, it's not looking back. This is what's coming up, not what you've done. So you're looking at, like, you do the whole coming year, January through December.
Right,
and
you're
you
gonna
can see, well,
project
wow,
how
we-
much,
Right,
right.
I mean, last year, we did 20,000 in sales in July. We can expect we're gonna do the same next July. And these are the expenses we have then.
Right.
So it's a projection, it's not a looking back, it's looking forward.
Right. Good point, very good point. Right. So the statement of cash flows might not necessarily be historical, it's going to be what you
Well, it's whatever you
expect.
look at, right? You're gonna have the historical as well as any
Yeah, right,
projections you wanna make.
absolutely.
You're gonna have
If
all.
your business has started already.
Yes,
if you don't know, this is
Right.
what your best guess is going to be.
And so maybe I have this wrong, but I think if you have an installment loan, like the gentleman down here, the interest portion of the payment, it's your expense, and your income and expenses here, profit and loss statement. But the capital portion of your payment doesn't show
Correct.
up, where in the cash flow, they both show up.
Correct.
Kind of put it in perspective for you. Profit and loss is wonderful. Suppose you're in a manufacturing business. In my case, I had a retail business. I could have, if my inventory went from 100,000 to 400,000, I'm still going to show a profit in my business. However, I may not have any money. I may not be able to pay the electric bill.
Right.
And that's the difference. The cash flow is really a management tool, and as you build history, you'll be able to start projecting ahead what your cash will be. Someone comes to you with a great deal on something, you say, wow, yeah, I can buy a year's supply of that and save 25%. But if it puts you in a position that you're gonna run out of money, now you're gonna cause yourself big other problems. So it's a management tool, but it's important, I think, to see both of those numbers to understand where you're at.
If you have questions, there is a link to my email and to my website for our firm. If you have other questions that we don't get through, or you think of something after the fact, please feel free to shoot me an email. And there are some materials on the table outside you can grab on the way out if you'd like. Okay, different types of software. We use QuickBooks quite a bit, but there's other ones out there, so just some suggestions and different strengths and weaknesses of them. Okay, and yeah, I think that's just talking about all these different, yeah, it's all informational.
It's really tough to try and cover this type of topic in such a short period. We really were intending to give you an overview, not dive deep, but we knew there were specific questions. You know, it's just hard. That's part of the reason why we haven't done this in the past, and we've gone even higher level. But we thought that, you know, you've been asking for this kind of thing, so.
So what are retained earnings?
Retained earnings are, so when you have your profit and loss each month or each year, as time goes on, you can't have a net income because that's only for that current year. So it's the accumulation of your net income or loss over
From year to year.
From year to year. No?
Any
Yeah.
other questions?
Oops, she's got one here.
So, say you start out as just like a sole proprietor and then you're expanding out to have people work for you and contractors. So, like the earnings, do you all of a sudden like start to pay yourself a certain paycheck? Because, I don't know, I guess I've been operating just as myself and so it's just like my money.
Right. Again, that's really
so
more
does
of a tax question than an accounting kind of question, because it's really based on the type of business, the tax, if you're filing in as a 1120 or 1120S or partnership.
Would you account for that if you paid yourself? Would that be a completely different expense?
Well, usually what it will do is it'll break out owner's wages compared to your employee's wages, if you are able to take your own wages, just so you can delineate between, again, it's all about detail and what you want to see.
I actually have a general question kind of for the group. So I do have FreshBooks, and I actually do use Davis and Hodgdon, and they're great. But it is time consuming to make entries, you know, to stop and have to make the entries. So I guess there are virtual assistants out there that do that sort of thing, although there don't seem to be a lot of virtual assistants here in this area. But I guess there are bookkeepers, and I just wonder if anybody's had experience with that and would say, gee, I think it actually, you know, I found that I've done this, and I did FreshBooks for a while as a solopreneur, which is what I am. But I just turned it over to a bookkeeper because I could focus more on my business rather than having to crunch numbers all the time or make these entries.
Right.
And it didn't cost that much more, or actually, it was cheaper than the FreshBooks account I had. which
Right.
in my case is $30 a month.
Right. Well, that's what we really are promoting with what we do with this remote accounting department, is that we can do those types of entries for you. We can pay your bills, we can reconcile your bank statements, we can, if there's loans, we can make sure the balances are correct, based on how much interest. There's so many different things that we can do throughout the year, so at the end of the year, you're not having that huge bill for your taxes because they're trying to do all these things that you didn't do, earlier in the year. If something wasn't booked in the right way, so we're keeping our eyes on things, so.
There are companies too around. I met one last week. I just don't remember off the top of my head who it was, but it's a local group. It's the one that's now teaching at the Women's Small Business Program. So there are local groups or businesses that are bookkeepers that will help keep your books for you. There's also a program going on at CCV right now to actually get people certified in bookkeeping so that hopefully more businesses will be coming up, but there'll be more since there's a heavy demand, as you said, no one wants to be putting this in and it's very tedious. So there is a push to increase the number of bookkeepers around in the area.
But, and I don't mean to monopolize time here, but I just want to make sure that I understood you correctly. So I do these entries, or I have somebody else do the entries, but I use Davis and Hodgdon not to do those entries because it seems to me, to be very honest, it would be expensive for me to pass that stuff to Davis and Hodgdon to do that stuff. Whereas it would be cheaper to do that through a bookkeeper or through FreshBooks or QuickBooks or whatever.
The only advantage,
but I use
right.
Davis and Hodgdon to say, okay, here's all the stuff they've given us, now we're gonna take a look at it, and we're gonna figure out if this is done correctly, excuse me, and then how to take care of our client in the best possible way we can.
I think the problem comes in the fact that most businesses aren't big enough to hire a bookkeeper that's full-time. So anytime you hire someone part-time, there's always a good chance that they're not gonna stick around. So you finally get them up to speed as to how things should be entered, and then they're gone again, and then you have to find a new one. And there is definitely a shortage in the area. I mean, that's one of the reasons I'm by myself, is because we're trying to find someone else to come in and add to our department.
When you're presenting these accounting sheets, what's the order? Like if you're like if I was presenting to a board my financials, do I present the balance sheet first and then I know it's silly, but it's good. Do you P&Ls second or what's the
I don't think there's a right or a wrong way. It's really what you're focusing on for the board. Are you looking at what your worth is in that business, or are you looking more at the detail of what did we make this month compared to last month, or?
It'll depend upon whether you're managing your business or whether you're looking for funding or for what, it depends. Tax time, you have different things too, so.
Right.
So we've hit our time limit, so one more quick question, maybe?
On the first sheet, and it has in both the assets and liabilities, there's just accounts receivable and then accounts payable, and then other current assets. Would that include things like materials that you own but haven't used yet, or what goes under that?
Right, it could be like an inventory kind of thing. That's something short-term, though. Inventory, when I put that out there, I thought, well, maybe not, because inventory is generally thought of as a longer term because you're holding on to it longer, but, yeah.
Like soil and plants,
Mm-hmm.
which is kind of used within here or something.
Right, something that needs to be, used up. Any other questions?
So we're actually out of time. I need to start wrapping things up. As you can tell, we've been videotaping this.